I think we're definitely seeing earnings under pressure, but not unexpectedly so. I think the last year is now coming through. The hard times of last year is now coming through in the earnings, and I suppose that's coming through in all the updates where we're seeing from 55% to 75% down, in some cases losses. But I suppose the next question is this the bottom of it? Have they managed to cut enough costs so when earnings come through they can get the boost from going forward?
You're very good at interviewing yourself, because that was my next question. Do you think that the trend, the second half in some cases is going to be better because some companies have jumped that curve and already taken their cost-cutting pain?
Yeah, I think so. I think there's been a lot of cost cutting, and I think if one just looks at what the index as a whole has done, if you take it from its high in November 2007 to the low in March last year, the index has lost 40%, and then it's recovered most of that from March last year to now. But earnings are probably still back to around about 2005 levels, and they probably go even lower with all these trading updates that are coming out once those are in the numbers. So the second half, admittedly, it's going to be off, or the next year and the second half is going to be off lower bases. So we should see some kind of recovery because we are seeing the economy coming through as well. And I think that's what the market's anticipated by running ahead of the earnings.
Digicore out today. Can you give us an update on that front, specifically from a valuation perspective?
Well, again, I think they obviously benefited quite heavily from the economy in the past, and both locally and globally, and obviously the downturn has affected them as well. And so we're going to possibly see around about a 50 to 65% drop in earnings this half. But bearing in mind, there's also a lot of cost cutting within the business as well. So I think it puts it on a multiple of around about 11 times now. So not excessively priced, despite the huge drop in earnings. The market probably expecting that as well.
Comment on Iliad, Cash Build. We saw those companies out last week. From a valuation perspective, are these looking attractive, or have they run ahead of themselves?
Again, it's a difficult, especially the Iliad scenario, because there you're looking at around about 75% drop in earnings, and that takes the PE multiple currently of about 6 times to about 16 times. So I suppose one needs to get a grasp of the actual numbers to see what management has done in order to benefit going forward. From a cash build perspective, it's not a train smash. I think they're expecting earnings to be down around about 23 to 29%, which means you're looking at a PE multiple of about 11 times, and there they're blaming wage increases as well as poor demand from the neighbouring countries. So if the wage increases are in the numbers, and if the demand comes back through the neighbouring countries, then we could see a reversal of that. And that's on a PE multiple of 11 times, so not excessively priced in this environment.
What about the agricultural sector? If we focus on a stock like Afgri, that company also out with earnings last week, is this an area or an arena that is attractive given the fact that ultimately we are going to see food shortages across the continent?
Well, I think that's exactly it. Agri-businesses are great businesses because people always need to eat, and they always need those inputs that go into foodstuffs, and hence the PSG's Zeta, which is also very heavily linked to agri. But on Afgri's basis, it's very difficult to compare the company now to in the past, because there's been a lot of restructuring within the business, a lot of cost cutting as well. From a maize perspective, we're going to probably have our third bumper season of maize, which benefits Afgri because if we're consuming less than what we're producing, it means maize needs to be stored, and their silo business will benefit from that. So I think agri businesses at the right price are always good businesses to hold, especially in Africa, because this is probably where the demand is going to come from going forward from the rest of the world.
Shawn, recently I've spoken to a number of commentators who say, given the fact that valuations are pretty equal across financials, industrials and resources, in the large caps, they're looking into the mid and small cap arena for value. Is this a trend we're going to see continuing? Is it a trend that you advocate at this stage?
Well, I think it's part of a normal cycle. As you rightly said there, people look for value in where the liquidity in the larger caps first, where there's more stability, and then they start to look further and further down the curve. And I think if one just takes the forward multiples that we're seeing for the JSE All Shares, around about 12 times 1 year out, and for the small caps, around about 9 times 1 year out. So definitely a value within the sector going forward. And I think that's just a normal process of how the cycle works its way out.